Some investors looking for a way to hedge against future inflation are considering tips. The BlackRock Inflation Protected Bond Portfolio has been a top-performing fund, ranking in the top quartile since its inception in 2004. Martin Hegarty is the co-manager of the fund. He is also co-head of global inflation-linked portfolios at BlackRock. He helps to manage $24 billion of the $3.6 trillion that the firm has under management. Martin is with us now with more. Martin, thanks so much for coming in. Glad to have you with us. As you have pointed out, it's pretty much been nirvana as far as if you're into tips, this is your season, right? But at what point does that change?
Well, firstly, thanks for having me, Deirdre. I guess the last 12 months have definitely been nirvana for tips, as you say. We've had expectations for growth coming down and in some cases even collapsing. And in that same time frame, we had commodity prices, whether it's as a result of QE2 or not, have actually moved sharply higher. So we had oil, moving from the middle of last year from mid-70s up into, $115 a barrel with the Arab Spring, as it were. And that's driven headline inflation sharply higher. And as tips are paced, or the coupon payment is based on headline inflation, you've had real rates coming down as expectations for future growth are revised lower at the same time as headline inflation going up. So that's been a windfall in both aspects.
That's been a windfall in both aspects. I mean, how can tips actually be used, though, as a portfolio diversifier, as an inflation hedge? I mean, what is the best advice when you reach out to clients? Why and how much should they own?
Well, I think the important thing to understand is when using tips as an inflation hedge, they are an inflation hedge for fixed income investors, because bear in mind there is some duration component to the product, and particularly as rates go lower, that duration component is getting bigger. So, I would advise most, depending on who I'm speaking to have somewhat of an allocation to tips. Definitely as people get nearer and nearer their retirement, they are not able to hedge their spending through increased earnings. So as one gets nearer and nearer retirement, I think it's imperative that one owns some inflation assets.
Now, you're mostly in the U.S., right? When we're talking about tips, not so much exposure to Europe right now.
Well, we have a $24 billion business, as you mentioned, and I would say 55% of that is U.S. focused. The balance is made up of global mandates, which there is some European exposure in there, Australian, Canadian, Swedish. So we run the full gamut of inflation products around the world.
So if you're watching that zone, just out of curiosity, I mean, what do you see there? Do you see the Eurozone staying together? Do you see members breaking off? I'm just curious because all of this goes into your calculations, obviously.
Yeah, we've actually recently reduced a lot of bearish European bets that we had. 6 months ago, we were very bearish on European inflation expectations.
So you're feeling better these days?
Well, not necessarily feeling better, but with Italy and Spain coming under pressure, we do feel that they are too big for the Eurozone and Eurozone policymakers to ignore any longer. So I think that we're getting nearer and nearer to somewhat of a solution that will be implemented. I'm not sure exactly what form that is going to take, but I think with Italy and Spain being at the brunt, we will see some policy action out of Europe, whether it's ECB or something on the Eurozone governmental side. It remains to be seen, but I think we're getting nearer that point in time.
How, if bringing it back to the U.S. before we let you go, is QE3 changing anything, if at all, for what you're doing with 55% of the portfolio, which is focused on the U.S.?
Yeah, within our global portfolios, a lot of that is U.S.-based as well. So it affects more than just 55%. But the biggest driver that QE1 and QE2 has been to sort of, I wouldn't say debase the dollar, but cheapen it on a global basis and drive short real rates lower in the U.S. And that's had a lot of implications for zero duration assets, such as oil prices, gold, silver. And what we're seeing now is the focus on the long end of the curve and not expanding the balance sheet has actually strengthened the dollar. And that in itself is going to reduce headline inflation, which falls in line with our thesis that headline inflation will continue to come down, probably going until the end of 2012, while we see core inflation actually picking up or continuing its ascendance into the end of the year and somewhat calibrating probably 25 basis points lower over the course of next year. So what we're trying to do is we're trying to look for places where we think the Fed wants to drive long real rates lower. And with that in mind, we're focused on the long end of the curve. We're cognizant of the fact that short-term headline inflation will continue to trend down. That, I think, will have impact on particularly the front end of the curve, as that is more sensitive to.
So real rates will stay low.
I think real rates will stay low, particularly the further out the curve you go, and inflation expectations probably will remain relatively well behaved.
Martin, we hope you come back. Thank you very much. Martin Hegarty joining us there from BlackRock. You heard him say real rates will stay very low.